Well, good morning, everyone, and let me just say a word of thank you, Stephen, for inviting me to join the panel this morning. I think it's really an important opportunity to share a few thoughts about the U.S. economy, and also, I think, a very important moment to take a look at where our economies are and assess really how far we've come since the onset of the major economic recession and the global financial crisis. While it's really not so long ago, it feels like a lifetime since then U.S. Treasury Secretary Hank Paulson and Federal Reserve Bank Chairman Ben Bernanke met with members of Congress in September 2008 to explain the sobering depth of the financial crisis, including the impending collapse of Lehman Brothers, the crisis facing AIG, and more broadly, the real threat to the U.S. economy and the global financial world. And Congress responded, as you all know, by approving an major emergency bailout, the $700 billion Troubled Asset Relief Program to stabilize troubled banks, automakers, insurance companies, secondary markets for consumer and small business loans, and the housing sector. Now, it's almost been forgotten that this was the major crisis facing President Obama and his transition team in the late autumn of 2008. Even before he was sworn into office, in fact. Working with Congress, though, they achieved early passage of the American Recovery and Reinvestment Act, which was signed into law on February 2009, less than a month into the president's first term. And it had the goals of creating jobs and promoting economic recovery, assisting those most impacted by the recession, investing in technological advances in health and sciences, in transportation, environmental protection, and other infrastructure, and stabilizing state and local budgets. The Recovery Act provided a quick boost to the economy, and with GDP already in the third quarter of 2009 moving in a positive direction, and continued positive growth on a pretty steady trajectory with a couple of minor exceptions since then. And major investments funded by the Recovery Act, now estimated to total $832 billion through 2019, included more than 15,000 transportation projects, high-speed rail and water quality improvements, high-speed internet connectivity, and renewable energy, which have all had a positive impact on economic growth. And of course, other key administration policy responses to the crisis included steps to stabilize the housing market, auto and financial industries, and small businesses. So I'm pleased to be able to say that the worst of the global financial crisis, we think, is now behind us, and today the United States has come back. And as President Obama noted in his State of the Union address this year, housing starts are up, the market is rebounding, banks are lending again, manufacturing jobs are increasing, and unemployment is in decline. Businesses have added some 8.5 million jobs since early 2010, and while still higher than we'd like, the May unemployment rate of 6.3% is at a 5-year low, the lowest rate since September 2008. And we're also seeing the unemployed now re-entering the labor market, and new entrants as well into the labor force in bigger numbers. So overall, this is very positive. In terms of economic growth, following 11 straight quarters of positive growth, it's true that in the first quarter of this year, momentum slowed a bit with a decline of 1.1% in GDP as a harsh winter conspired with other factors. But recent U.S. Treasury data suggests that a meaningful rebound is now underway for the rest of the year, with growth projected at 2% and rising to 3% in 2015. And with better growth prospects, of course, the U.S. should see steady progress in more new jobs and employment. In addition, America is selling more goods and services abroad than at any time in our history. U.S. exports have hit an all-time high, a record $2.2 trillion. Today, those exports support 11.3 million jobs, accounting for 14% of the U.S. economy. And the Federal Reserve, as was mentioned, has begun the delicate task of ending quantitative easing. While we're seeing some reaction in the markets, it's being done in a measured and responsible way that keeps careful watch on its effect on both the U.S. economy and the rest of the world. Yet even with these strong signs of economic recovery, we recognize that important challenges remain, including unemployment that is still too high and economic growth that is still too slow, with many individuals and families still not feeling the full benefits of the recovery. So where are we focusing our efforts today? President Obama, during his 5th visit to the Asia-Pacific region in April, outlined 3 priority areas that we see as critical to our long-term growth and continued economic recovery. These include job creation, trade and investment, and innovation. So let me say just a few words about each of these. First, our workforce. U.S. workers are among the most creative, hardworking, and resilient in the world, and they truly are the backbone of our economy. But the overall growth in our workforce, despite recent gains, has slowed. From 1948 to 2007, we added about 93 million people to our workforce, or about 2% per year. And since the financial crisis, the average annual growth in the U.S. workforce, while positive, has been just 1%. And since 2008, the labor force participation rate has actually fallen by 2.7 percentage points. The Council of Economic Advisors estimates that about half of the decline is a result of our aging population as the baby boomer generation begins to leave the workforce. For every job opening in the U.S. economy, there are now 2.2 unemployed, and about 1 out of 3 unemployed workers has been out of job for more than 6 months. So the issue of long-term unemployment remains a real concern. Another key factor in tackling unemployment is education and making sure that our current and future workforce is well skilled. The U.S. has a world-class education system which includes 90 of the world's top 200 universities, but we need to address uneven access to quality education and continue to improve early, middle, and high school education. And we're also working to provide access to a wider range of post-high school education options, including not only 4-year universities, but associate degrees, industry-accepted certifications, and earn-while-you-learn apprenticeships to ensure the next generation entering our workforce is skilled up for 21st century jobs that will keep the U.S. economy on a globally competitive growth path. Second, let me say a few words about our efforts to drive both investment and trade. For years, we've heard that businesses need more confidence in the future before they will invest again. But indices of both consumer and business confidence are stronger now than they've been in a long time. And I noticed that global executives in a recent survey ranked the U.S. as the #1 destination for business investment for the 2nd year in a row, citing our productive workforce, sizable and transparent markets, low-cost energy, and lead in innovation. And the U.S. manufacturing sector in particular, which represents 12% of GDP, has turned a real corner. For the first time in over 10 years, output has grown 38%, and the sector has added 646,000 jobs, with another 243,000 positions on offer. The fastest unemployment expansion in this sector, really, in nearly 2 decades. And U.S. renewed competitiveness in manufacturing is bringing back production to the U.S. from some overseas locations as well. And we've seen a real significant transformation in the U.S. energy sector, as many of you know, thanks in large part to the boom in shale gas, which has led to a 25% increase in natural gas production since 2007. We've also increased our oil production by 1 million barrels per day in each of the last 2 years, and are on track to replicate that again this year. And as the 3rd largest producer of oil and gas worldwide and the leader in production growth, the U.S. is now expected to become the world's largest oil producer by around 2020, and with continued emphasis on more efficient uses of energy to become nearly energy self-sufficient by around 2035. At the same time, we've redoubled renewable energy production from wind and solar. And to encourage investments in other sectors, we're also focusing on infrastructure improvements, part of the focus of the Recovery Act, building the roads, railways, bridges, and ports that will create more jobs and lay a foundation for future economic expansion. Now, all of these developments present significant opportunities for foreign investors, too, such as Australia's superannuation funds, which were referenced a little earlier, which we think offer a natural fit to long-term infrastructure investments. We see this as a potential win-win for all sides, not only for the U.S. and the Australian super fund industry, but for other interested Australian companies, too. I'd like to make just a few points at this stage about the U.S.-Australia trade and investment relationship to underscore the scope and significance of our economic partnership. And I think a few statistics really speak for themselves. In terms of investment, the U.S. is by far Australia's largest foreign investor, with FDI stock of approximately $132 billion. And if you include portfolio investment, U.S. investment in Australia exceeds $600 billion. Even more compelling is that U.S. FDI in Australia accounts for 24% of the total. By way of comparison, the figure is 50% greater than Australia's next largest investment relationship with the UK, and more than 30 times the total stock of Australia-China two-way investment, which totals $32 billion. In the other direction, Australia's investment footprint in the U.S. is also growing rapidly. The United States is the #1 destination for Australian outbound FDI, and Australia is currently the 10th largest foreign direct investor in the United States at $56 billion. And if you include portfolio investment, that number exceeds $400 billion. Now, turning to the trade ledger, since the Australia-U.S. Free Trade Agreement went into effect in 2005, trade between the U.S. and Australia has nearly doubled to about $65 billion a year. Australia is the U.S.'s 15th largest goods export market, and the U.S. is Australia's 5th largest export market. So in both quantity and quality, our two-way trade and investment remains enormously important, translating into more jobs, more goods, and real economic benefits. And if you'll permit me, I'd also like to say just a few words about the Trans-Pacific Partnership Trade Agreement, which is a major priority for both of our governments and really the economic centerpiece of the U.S. strategic rebalance to the Asia-Pacific and our commitment to building prosperity in the region. We believe that the TPP will become a model for addressing new and emerging trade issues in the 21st century, and that all of the 12 countries involved in the process, including the U.S. and Australia, will have greater access to a trading area that produces 40% of the world's GDP, creating more jobs and better jobs. The TPP will also include strong protection for workers, the environment, intellectual property, and innovation. And it will promote the free flow of information, help spread green and innovative technologies, improve the coherence of regulatory systems, and increase the supply chain efficiencies. In short, we believe that the TPP will make trade flow more smoothly and more easily, not only within the region, but beyond into broader world markets. And we're confident that the U.S. and Australia will be two of the major beneficiaries of this agreement. So let me say just a final few words about the important role of technology and innovation in the U.S. economy. Today, the United States is investing more in basic research through the President's Strategy for American Innovation, to the tune of about $400 billion in R&D every year. Now, to put this in some perspective, this is equal to the combined R&D spend of the top 10 Asian economies, including China, India, and Japan. And we're also making historic investments in clean energy technology and advanced vehicle technologies. And President Obama has made a strong commitment to science, technology, engineering, and math, STEM education, so that the next generation has the skills to keep developing new innovations and the training to be analytical and innovative in a competitive and global market. Americans are also working with scientists, researchers, and companies around the world, including right here in Australia, to share ideas and work together to develop the technologies and products of the future. Ideas from GE's employees in Western Australia, for example, have allowed those operations to streamline and improve their subsea production technology, trimming costs and improving productivity. And Ford is expanding its Global Design Center in Geelong, drawing upon the talented pool of innovative Australian engineers whose research will be crucial to solving the design challenges of the future. And similarly, IBM has hired 150 Australian computer scientists and engineers to do advanced research and development in Melbourne. And our National Institutes of Health is partnering with leading Australian scientists on world-class brain research in Queensland, Melbourne, and Adelaide. And these are just a few examples of the ways in which we're working together on developing innovation. So to help create a stronger network of bilateral cooperation in this area, I wanted to mention that our ambassador, Ambassador Berry, will be launching the first session of an Ambassador's Innovation Roundtable with representatives from across the Australian industry on July 30th at our embassy in Canberra, which we hope will open up even more opportunities for cooperation in this vital space. So what kind of economic future is the U.S. leaving to our next generation? Well, if we take the right steps, we'll continue to invest in all the areas I've just mentioned, in a well-skilled workforce for the future, encouraging investment that will drive real economic output and job growth, and invest even more in R&D and technological innovation. And investments in these three critical areas will continue to be the key to our long-term growth. And of course, how we make those investments will shape the economy and the opportunities for future generations to come.